Home prices in your city may be falling right now, but the cost of owning that home is quietly exploding. Mortgage payments remain high. Insurance premiums are surging. Property taxes and HOA fees are climbing. And for many homeowners, the math no longer works, even as prices slide. This is how a housing downturn really begins, not with panic headlines, but with slow financial pressure that traps buyers, sellers, and renters at the same time. Across parts of North and South Carolina, markets that were once sold as safe, affordable, and booming are now showing unmistakable signs of distress. So here's the question no one wants to ask. Which cities are making people poorer after homes become cheaper? To understand what is happening inside these 7 cities, you first need to understand why this housing downturn is fundamentally different from the cycles Americans are used to. This correction is not being driven by a sudden collapse in employment or a national financial crisis. It is being driven by a slow but relentless squeeze on affordability, one that pressures buyers and sellers at the same time. Interest rates reversed faster than household incomes could adjust. Monthly payments jumped even as home prices began to soften. Migration patterns that once fueled endless demand started to fade. The remote work surge cooled. Corporate relocations slowed. And investors who once competed aggressively for homes quietly stepped back. Yet supply kept rising. Developers continued building based on outdated assumptions. Entire suburbs expanded rapidly, expecting yesterday's demand to last forever. Instead, they created a growing inventory overhang, rows of homes waiting for buyers who no longer exist at current prices. What makes this cycle especially dangerous is that falling prices are not delivering relief. Insurance costs are climbing, particularly in coastal and high-growth regions. Property taxes remain elevated after years of appreciation. HOA fees continue to rise as communities struggle with vacancies, deferred maintenance, and shrinking reserves. The result is a market where prices can fall, but ownership becomes more expensive. Liquidity disappears. Sellers hesitate to cut deeply. Buyers hesitate to commit. Transactions slow, then stall. This is not a crash driven by panic. It is a freeze driven by arithmetic. And beneath the surface, something more structural is happening. The balance of power has shifted. Buyers are gaining leverage, but many cannot qualify. Sellers are losing control, but many refuse to accept reality. Investors, once the backbone of demand, are no longer absorbing excess supply. If you want to understand how this shift actually plays out, not in headlines, but in real neighborhoods, this is where the story matters. The 7 cities we are about to examine show what happens when growth assumptions collide with financial limits. If you find this kind of ground-level analysis valuable, take a moment to like the video, subscribe to the channel, and turn on notifications. These are not theories. They are real stories unfolding right now. And the first city reveals how quietly this unraveling can begin. 7. Wake Forest. Not long ago, Wake Forest was marketed as one of the safest bets in North Carolina. Just north of Raleigh, it offered quiet streets, good schools, and the promise of space for families escaping denser metro areas. During the pandemic boom, demand surged almost overnight. That surge is now fading just as quickly. Inventory in Wake Forest has climbed sharply over the past year, rising by more than 40% as new listings pile up faster than buyers can absorb them. Homes that once sold in days now sit for weeks, then months. Median days on market have nearly doubled, and price reductions are no longer the exception. They are becoming routine. This slowdown is not accidental. Builders expanded aggressively, assuming the wave of remote workers would last indefinitely. Entire subdivisions were planned and framed based on yesterday's demand. Today, many of those homes are complete, but unsold. At the same time, affordability has tightened. Mortgage applications in this area have dropped significantly as higher interest rates push monthly payments beyond what many local households can qualify for. Sellers are discovering that even modest price cuts are not enough to restart momentum. The rental market is also softening. Vacancy rates have begun to rise, signaling that population inflows are no longer offsetting new supply. Investors who once viewed Wake Forest as a low-risk hold are stepping back, unwilling to compete with discounted new construction. The real tension here lies in denial. Many sellers still believe prices will rebound quickly. Buyers are waiting, builders are stuck, and liquidity is draining from the market. So the question becomes unavoidable. What happens when a safe suburb turns into a waiting room where no one wants to move first? 6. Goose Creek. For years, Goose Creek was marketed as the affordable alternative to Charleston's historic core and coastal neighborhoods. It offered lower prices, newer subdivisions, and the promise of homeownership for buyers priced out of the city. During the boom, that message worked. Perhaps too well. Nope. Developers flooded the area with entry-level housing, assuming demand would remain constant. Today, that assumption is unraveling. Active inventory in Goose Creek has surged by more than 50% compared to last year. Homes that once attracted multiple offers are now sitting idle, accumulating days on market with little interest. Median prices have begun to slip quarter over quarter, signaling that sellers are no longer in control. The deeper problem lies in who is no longer buying. Investor activity has dropped sharply, removing a critical source of demand. At the same time, foreclosure filings have started to rise, a leading indicator that financial stress is spreading beneath the surface. These are early warning signs that rarely appear in isolation. Builders facing growing backlogs are responding aggressively. New construction incentives have escalated, with concessions reaching into the tens of thousands of dollars. While this helps move inventory, it quietly destroys resale values for existing homeowners, who must now compete against brand-new homes sold at discounted effective prices. Affordability has also deteriorated. Higher interest rates have narrowed the buyer pool, particularly for first-time buyers who once formed the backbone of this market. As demand weakens, the sale-to-list price ratio continues to fall, confirming the shift toward a buyer-dominated environment. Goose Creek now faces a dangerous imbalance. Too many similar homes, not enough qualified buyers, and no clear catalyst to restore momentum. So the question is simple but unsettling. What happens to an affordable suburb when affordability disappears first? 5. Indian Trail. Indian Trail was once the textbook example of suburban opportunity on the edge of the Charlotte metro. It promised affordability, family-friendly neighborhoods, and quick access to jobs. During the boom years, prices accelerated rapidly, and demand seemed unstoppable. That acceleration is now the source of the problem. Home values in Indian Trail climbed far faster than local incomes could sustain. When interest rates rose, the affordability ceiling collapsed almost overnight. Inventory began to accumulate as months of supply tripled within a single year, a clear signal that demand had evaporated. Closed sales have dropped sharply, draining liquidity from the market. Listing prices have started to trend downward quarter over quarter, pushing recent buyers dangerously close to negative equity. At the same time, nearly 40% of transactions now involve seller concessions, with homeowners paying closing costs or offering credits just to keep deals alive. The investor retreat here has been dramatic. Activity has fallen by roughly half, removing a critical source of absorption that once supported rising prices. Showings per listing have declined, and days on market continue to stretch longer, reinforcing buyer hesitation. Financial stress is also becoming visible. Pre-foreclosure filings have increased, and mortgage delinquencies are edging higher. These are not panic-driven defaults. They are the result of households stretched by high payments in a market that no longer supports peak valuations. Indian Trail's story is not about collapse driven by fear. It is about rejection driven by math. Prices moved too far, too fast, and buyers simply cannot follow. So the question facing this market is unavoidable. When affordability breaks, how long can sellers wait before reality forces their hand? 4. Kannapolis. For much of the last cycle, Kannapolis looked like a comeback story. A former mill town reborn with a revitalized downtown and a new research campus, it attracted attention far beyond its size. During the boom, that attention turned into capital, and a large share of it came from institutional investors. That support is now gone. Institutional buying has collapsed, leaving a sudden vacuum in demand. Inventory has climbed rapidly as homes once absorbed by corporate buyers now sit unsold. Nearly half of active listings have been forced to cut prices, a sign that competition among sellers has turned desperate. The consequences extend beyond pricing. Days on market have more than doubled, and vacant homes are becoming more common. New construction permits have fallen sharply as builders pull back, recognizing that the market can no longer support speculative expansion. What makes Kannapolis especially vulnerable is how dependent it became on non-local capital. When Wall Street money was active, prices held. When it exited, there was no natural buyer base large enough to replace it. Local incomes simply cannot absorb the volume at recent valuations. Early distress indicators are beginning to surface. Foreclosure rates are ticking higher than the national average, and long-term vacancies are rising. These are the quiet signals that appear before broader declines become visible in headline prices. Kannapolis was not lifted by organic demand alone. It was propped up by momentum and money that moved quickly and left just as fast. The question now is uncomfortable but essential. When the biggest buyers in town disappear, who is left to hold the market together? 3. Gastonia. Gastonia has long been positioned as the last affordable option on the western edge of the Charlotte metro. Once a struggling textile town, it was rebranded as a comeback story, close enough to the city, cheap enough to attract buyers priced out elsewhere. During the boom, that narrative pulled in investors and speculative buyers in large numbers. That demand has now vanished. Pending sales in Gastonia have fallen sharply, while inventory has surged to one of the highest levels in the region. Homes are sitting longer, price cuts are widespread, and median sale prices have already begun to decline year over year. This is not a warning sign, it is confirmation that the downturn has arrived. What sets Gastonia apart is speed. Investor purchases have collapsed, removing the primary exit strategy for many sellers. Without that backstop, listings linger. Days on market continue to rise, and distressed sales are starting to reappear, including short sales and bank-owned untouchable properties that were nearly absent just a year ago. The rental side offers no relief. Rent growth has turned negative, squeezing landlords who relied on appreciation to offset thin cash flow. As vacancies rise, the pressure on investors intensifies, pushing more inventory back onto an already saturated market. Gastonia is often described as the weakest link in the Charlotte metro chain. That weakness is now visible in the data. Prices are falling, liquidity is evaporating, and confidence is breaking down faster than in surrounding areas. This is why markets like Gastonia matter. They do not just fall first, they signal what may come next. So the question becomes unavoidable. If this is the first suburb to break, which ones are standing directly behind it? 2. Mount Pleasant. Mount Pleasant is often portrayed as untouchable. Tree-lined streets, gated communities, luxury boutiques, and proximity to the coast helped define it as one of the most desirable and expensive suburbs in the South. For years, the assumption was simple. Even if other markets cooled, Mount Pleasant would hold. That assumption is now being tested. The luxury segment here has frozen. Inventory at higher price points has surged, while sales of homes above $1 million have dropped sharply. Properties that once moved quickly are now sitting for months, trapped in expensive holding patterns. Large price cuts, sometimes exceeding 6 figures, have become necessary just to attract attention. The pressure is not coming from price alone. Insurance costs in this coastal market have climbed dramatically, adding thousands of dollars per year to ownership expenses. Combined with elevated interest rates, monthly payments have effectively doubled for many buyers. At the same time, jumbo mortgage lending has tightened, removing access for buyers who once powered this market. What makes Mount Pleasant's slowdown especially revealing is who is stepping back. Wealthier buyers are not rushing in to catch discounts. They are waiting. Developers have paused new custom builds. Sellers are discovering that prestige does not guarantee liquidity. Even the sale-to-list price ratio has deteriorated, signaling that negotiation power has shifted decisively away from sellers. This is not panic selling. It is paralysis driven by affordability and risk. Mount Pleasant shows that no market is immune when costs rise faster than confidence. So the question lingers. If even the most desirable suburbs can freeze, where does safety really exist? 1. North Charleston. North Charleston has always carried a different reputation than its historic neighbor across the river. More industrial, more volatile, and long considered a riskier bet. During the buying frenzy, however, that reputation was temporarily ignored. When inventory disappeared elsewhere, buyers came here out of necessity, not confidence. That distinction now matters. North Charleston is facing a perfect convergence of pressure. Inventory has exploded, pushing months of supply beyond 5, a level that firmly places control in buyers' hands. Prices are already down sharply year over year, marking the steepest decline across this entire list. Homes are sitting longer, often without serious offers, as sellers compete in a market that no longer supports peak valuations. Distress is no longer hidden. Foreclosure filings are climbing at one of the fastest rates in the region. Investor activity has nearly flatlined, removing speculative demand entirely. Rental instability is growing as eviction rates rise and vacancies persist, eroding cash flow for landlords who once relied on appreciation to justify thin margins. Unlike other suburbs, North Charleston also faces compounding social pressure. Higher crime rates continue to deter families and long-term buyers, while localized economic slowdowns weaken job security. These forces amplify financial stress, turning a housing correction into something more structural. The sale-to-list price ratio has fallen decisively, confirming that sellers have lost leverage. Discounts are no longer strategic, they are defensive. What remains is a market searching for a floor without a clear source of demand to establish one. North Charleston is not cooling, it is correcting in full view. And it raises the hardest question of all. If this is where the cycle breaks completely, how far does the damage spread next? Taken individually, each of these 7 cities appears to have its own explanation. Different price points, different buyer profiles, different local pressures. But together they reveal a single, unmistakable pattern. This downturn is not about one bad decision or one unlucky market. It is about a shared belief that growth was permanent, that migration would never slow, that investors would always step in, that prices could rise faster than incomes without consequence. That belief is now collapsing. Across these cities, the same forces are visible. Overbuilding based on outdated demand, investor capital exiting all at once, buyers gaining leverage but losing qualification, sellers holding on to yesterday's prices in a market that has already moved on. And costs, insurance, taxes, interest, rising even as values fall. This is why cheaper homes are not bringing relief. Ownership itself has become heavier, riskier, and less predictable. Liquidity has vanished. Confidence has fractured. What remains is a market governed not by optimism, but by arithmetic. The lesson here is not that housing is doomed. It is that assumptions are dangerous. Markets do not collapse when people panic. They weaken when expectations quietly break. The question now is not whether these cities will recover. It is when and under what conditions. Will prices fall far enough to restore affordability? Will incomes catch up? Or will this correction stretch longer than most homeowners are prepared for? If you are living in one of these cities or considering buying into one, the most important step is awareness. Numbers matter more than narratives. Cash flow matters more than headlines. And patience may matter more than timing. If this analysis helped you see the market more clearly, take a moment to like the video, subscribe to the channel, and turn on notifications. And share your experience in the comments. Are you seeing these shifts where you live? Because this story is still unfolding, and the next phase may already be closer than it appears.